Cash flow determines whether you control your decisions or your decisions control you. People who think like employees wait for permission, wait for clarity, and react after the situation has already changed. People who think like bosses allocate resources before pressure arrives, protect liquidity before expansion, and make decisions based on outcomes, not moods. If you want to think like a boss, you need to stop measuring your life by effort alone and start measuring it by leverage, optionality, and control. That shift matters because the market does not reward busyness. It rewards positioning. A company can have talented people, strong energy, and constant activity, and still destroy value if capital is misallocated, timing is weak, and risk is poorly managed. Your life works the same way. You can be hardworking, intelligent, and ambitious, and still remain stuck if your decision framework is reactive, emotionally driven, and structurally weak. Thinking like a boss means learning to see systems, not just tasks. It means asking what moves the whole machine, not just what keeps you occupied. You need to understand the mechanism underneath this. In markets, outcomes are driven by liquidity, momentum, interest rates, volatility, positioning, and cash flow. In leadership and personal advancement, those same forces appear in different language. Liquidity is your time, your money, and your attention. Momentum is your current trajectory, your reputation, and the speed at which your actions are creating opportunities. Interest rates are the cost of delay, the price of indecision, and the opportunity cost of staying small. Volatility is uncertainty, setbacks, changing conditions, unstable markets, and unpredictable human behavior. Positioning is where you stand before the next event happens. Cash flow is the stream of value you create, control, and retain. Most people misunderstand this because they think thinking like a boss means acting confident, talking louder, or pretending to be in charge. That is surface-level imitation. So the first principle is that a boss thinks in terms of outcomes, not activity. Activity is easy to fake. A full calendar can hide weak judgment. A busy team can hide weak priorities. A tired person can still be unproductive if effort is scattered. You need to stop using motion as proof of progress. When the market rallies, not every trade is intelligent. Sometimes price movement flatters weak process. In the same way, being busy can flatter weak thinking. You need to ask whether your actions are compounding value or simply consuming energy. The second principle is that a boss protects liquidity. This applies to business, investing, and life. Liquidity means room to move. It means cash reserves, flexible time, emotional control, and the ability to wait without collapsing. If you have no room, you cannot negotiate well, think clearly, or take advantage of opportunity. You become reactive. A boss knows that forced decisions are usually bad decisions. If the market drops and you are over-leveraged, you sell at the wrong time. If your life has no liquidity, you accept the wrong deal, the wrong job, the wrong partnership, or the wrong expense simply because you cannot afford patience. The third principle is that a boss thinks in probabilities, not guarantees. Most people want certainty before they move. That mindset keeps them late. They want perfect information, perfect timing, perfect confidence. But markets do not offer certainty. Leadership does not offer certainty. You need to make decisions with incomplete information and then manage risk intelligently. Boss thinking means you do not ask for certainty. You ask whether the odds are favorable, whether the downside is survivable, and whether the upside justifies the exposure. The fifth principle is that a boss sees people and incentives clearly. You do not manage a team, a client, a market, or a partnership by hoping everyone behaves well. You study incentives. In markets, money moves according to incentives, liquidity, fear, and positioning. In real life, people also respond to incentives, security, recognition, pressure, and self-interest. If you do not understand what drives behavior, you will misread situations constantly. Thinking like a boss means you stop taking everything personally and start reading structure. What does this person want? What are they optimizing for? What are they afraid of? What pressures are shaping their decision? That perspective gives you leverage without drama. Now bring this into practical application. Start with the way you manage your own day. If you think like a boss, you do not begin the morning by reacting to incoming noise. You begin by identifying the few decisions that actually move outcomes. You protect the first block of your energy for high-value work, not for passive response. If your day is consumed by messages, notifications, low-value meetings, and scattered obligations, you are not leading your time. You are renting it out in fragments. A boss protects prime decision-making energy because that is where strategic value is created. Then look at your money. If you want to think like a boss, you stop spending based on how hard you worked and start allocating based on return. If income rises, you do not immediately reward yourself with fixed cost expansion. You first increase liquidity, reduce fragility, and build ownership. If the market moves higher, you do not chase exposure just because you feel late. You check your plan, your position size, your time horizon, and your risk tolerance. If the market moves lower, you do not panic unless your system was weak to begin with. That is the point. Boss thinking is not emotional courage. It is structural preparation. Apply the same logic to career decisions. If you are offered a raise that increases income but reduces flexibility, drains energy, or limits future upside, you do not evaluate it only by salary. You evaluate it like an investor evaluates a company. What is the quality of the cash flow? What is the growth path? What is the hidden risk? What optionality does this create or destroy? A boss does not automatically say yes to more money if the system underneath the money is getting worse. Sometimes a lower-paying role with higher learning, better positioning, and stronger long-term leverage is the better trade. You also need to learn position sizing in your personal decisions. This is where a lot of ambitious people fail. They are right about the direction, but wrong about the size. They start a project too big. They commit too much capital too early. They hire too fast. They invest too heavily in one idea. They bet on a forecast instead of building around uncertainty. In markets, a good thesis can still fail if the position is oversized. In life, the same is true. You can believe in your business, your career move, or your investment, but if the decision is sized too aggressively relative to your liquidity, you lose the ability to stay in the game. So if the environment is uncertain, you react by reducing commitment size and increasing feedback speed. If revenue is unstable, you react by protecting cash and delaying fixed expansions. If demand is rising and the data supports it, you scale gradually instead of emotionally. If a decision has irreversible downside, you slow down. If a decision has limited downside and strong learning value, you move faster. That is boss thinking. You do not treat every decision as equally urgent or equally large. You match speed and size to uncertainty and consequence. You also need to stop confusing confidence with clarity. Some of the worst decisions are made by people who sound certain and have never tested their assumptions. A boss does not just believe, a boss checks. What does the data say? What does the cash say? What does the behavior of the market, customer, or team say? What signal are you ignoring because it is inconvenient? Boss thinking is calm because it is reality-based. It does not need to be loud because it is not trying to compensate for weak foundations. This is where most people stop, but this is the advanced level. The advanced level is understanding second-order effects. A boss is not just managing the first result of a decision. A boss is managing what that decision changes next. Raise prices, and you do not just affect margin. You affect customer mix, expectation, retention, and brand position. Hire someone, and you do not just add labor. You add management load, culture impact, coordination cost, and future obligation. Buy a larger home, and you do not just change comfort. You change burn rate, lifestyle baseline, stress level, and future flexibility. The first-order effect is usually obvious. The second-order effect is where real strategic thinking begins. This matters because most people evaluate decisions in isolation. Bosses evaluate them in sequence. One weak decision changes the probabilities of the next 5. One strong decision can improve the system for years. If you increase your fixed costs too early, now every future decision is made under pressure. If you build a cash reserve first, now every future decision is made with patience. If you outsource too much, now your time may feel easier, but your cost structure is worse. If you overcommit to one income source, now your entire system becomes vulnerable to one point of failure. Boss thinking means you see the chain, not just the link. This is how mode change happens. In calm times, weak structure can look acceptable. The market is supportive, income is flowing, people are cooperative, and optimism is high. Then conditions shift. Liquidity tightens, sentiment weakens, volatility rises, costs increase, time pressure appears. Suddenly, the same system that looked functional now becomes fragile. The person who was relying on confidence is exposed. The person who was relying on structure stays calm. That is the difference between performative control and actual control. There is also a correlation problem that matters here. Many people think they are diversified because they have multiple moving parts, but in reality, those parts are correlated. Their income depends on one employer, their spending depends on continued growth, their debt depends on stable rates, their identity depends on visible success, and their investments depend on bullish markets. When one thing weakens, everything weakens. Boss thinking breaks correlation where possible. It builds multiple ways to survive. It keeps liquidity. It lowers fixed costs. It avoids dependence on one fragile assumption. Bankruptcy mathematics exists outside formal bankruptcy. You can become strategically bankrupt long before you become legally bankrupt. That happens when obligations rise, flexibility falls, liquidity disappears, and every choice becomes defensive. You may still look successful, but you are no longer operating from strength. You are operating from maintenance. Bosses work hard to avoid that state. They are not obsessed with appearances. They are obsessed with preserving decision quality under pressure. That is why emotional discipline matters more than surface confidence. The behavioral traps are serious. Overconfidence after one win. Expansion because things feel good. Chasing trends because other people seem to be accelerating. Spending to maintain an image that has not been financially earned. Hiring or investing to feel important rather than to improve return. These are all boss killers. A real boss does not let mood set policy. A real boss creates rules before emotion arrives. So here is how you practice this skill. Start journaling decisions, not just results. Before a major move, write down the thesis, the expected upside, the downside, the liquidity impact, the timing, the feedback signal you will watch, and the point at which you would admit the decision was wrong. This matters because memory edits the past to protect your ego. Written reasoning gives you a clean audit trail. It shows whether you were disciplined or merely lucky. Then reverse test your assumptions. If revenue grows more slowly than expected, what breaks first? If costs rise, what becomes non-viable? If the market falls, do you still want the same exposure? If a partnership weakens, does the system survive? If your energy drops for 3 months, does your plan still hold? Boss thinking stress tests decisions before reality does. You do not wait for life to tell you where the weakness was. Maintain the skill with a review loop. Every month, review how your time was allocated, where money actually went, what decisions created leverage, and what decisions created drag. Every quarter, review whether your fixed costs rose faster than your resilience. Review whether your assets, skills, relationships, and optionality are compounding. Review whether you are building ownership or merely consuming the appearance of progress. The review itself is part of boss thinking because leaders do not assume, they inspect. You should also combine this mindset with other tools. Valuation teaches you not to overpay, whether for investments, talent, or status. Macroeconomics teaches you that environment matters, that rates and liquidity shape behavior, and that the same strategy does not work equally well in every phase. Technical analysis, used modestly, teaches timing and respect for trend conditions, which can help you stage decisions instead of forcing them. Risk management teaches that survival is not separate from growth. Survival is what allows growth to compound. Test this under controlled pressure. Run small-scale experiments before large commitments. If you want to think like a boss in business, test offers before scaling them. If you want to think like a boss with money, live on a tighter budget for 60 days and redirect the difference into liquidity or investments. If you want to think like a boss in career strategy, simulate the downside of leaving or staying before acting. If you want to build leadership judgment, make smaller decisions faster, with defined review points, instead of endlessly debating imaginary futures. Pressure reveals whether your framework is real. And here is the subtle point that most people miss. Thinking like a boss is not mainly about authority over other people. It is authority over structure. It is the ability to arrange resources, time, incentives, and risk in a way that improves outcomes over time. That is why some people have titles and still do not think like bosses, while others have no formal power and already do. The mindset is not about dominance. It is about intelligent control. So, if you want to learn to think like a boss, stop asking whether you are working hard enough and start asking whether your system is positioned correctly. Stop measuring status and start measuring leverage. Stop chasing activity and start protecting liquidity. Stop reacting to appearances and start reading incentives. Stop making first-order decisions and start modeling second-order effects. Once you do that, your choices become less emotional, your timing improves, your risk becomes more survivable, and your life begins to operate with the logic of ownership instead of the exhaustion of reaction. And if you go back through this carefully, you will notice that the entire framework turns on one quiet shift. The moment you stop asking, "What should I do next?" and start asking, "What changes the system from here?" That is usually the exact moment boss thinking begins.